Do you want to retire in 10 years? Do you know how to do it through investing? Well, I have some ideas how to make it happen. I've selected a handful of ETFs that I think will crush the market in returns in the coming decade. I'm Skylar James. Welcome back to the channel. Just as important to knowing which investments to choose is knowing which ones to avoid. A bad investment can sink your chances at retiring early, or retiring comfortably, or retiring at all. Remember, investing is hard. If it was easy, we'd all be billionaires. Success takes courage and research. And that's why you're here, right? Of all the rabbit holes to go down in YouTube, you've chosen finance. Because of that, I hope you'll be rewarded with knowledge and money. I'm releasing a 3-part series on this topic. This is the first of 3. Recently, I've been shifting away from years as an investor of individual stocks, instead shifting to both broad and thematic ETFs. I still own some single stocks, don't get me wrong, but it's becoming a smaller and smaller allocation of my overall holdings. Most of my new money is going into ETFs. This is smart investing for me. I have a family, a couple of businesses, and I have to travel a lot, so my time to analyze individual 10Ks, Qs, and P&Ls is limited. But I do feel like I have a great pulse on thematic and macroeconomic trends, which is why I gravitate toward ETFs. They offer diversity, rebalancing, and they offer exposure to companies that I might not otherwise have time to micromanage. And remember that as a creator, I want to create content that you like. So hitting the like button, smash, are we still doing that? How about just tap? Tapping that like button tells me which videos you'd like to see more of. And if you, the community, have additional ideas on retiring early, please leave a comment down below. I am eager to hear your opinions. So without further ado, let's talk about ETFs. The ETFs I've chosen have common traits. They are generally tech-centric. That shouldn't be a surprise to you because tech companies are growing their revenue faster than any other sector. Faster than, say, consumer staples, transportation, or utility companies. And take note that tech, to me, does not just mean the tech sector of the market. Sector constituents change all the time. Google is not in the tech sector. Did you know that? Facebook is not in the tech sector. Video game developers, EA and Take-Two, are not in the tech sector. In fact, all of those are all in the communications sector. Apply that to your ETF knowledge going forward. Tech sector ETFs don't include all of the tech companies. So a second thing to consider, I want to lock in my positions today and not touch them for 10 years, aside from adding to their positions. That means I need to avoid ETFs, sectors and niches that are hot today but could fizzle out before the 10-year horizon is met. What comes to mind immediately as an example is the energy sector. Fossil fuel energy stocks have been hot recently. As I'm writing this, XLE is up over 50% for the year. Can that outperformance continue for 10 years? Or are we more likely to return to the norm of energy being the worst performing S&P sector? My gut says the latter. I don't want to be chasing fads and temporary surges. I want to catch the wave before other surfers see it. So this ETF list is built with that idea in mind. And the third and final caveat, single stocks still have their place. I can't even create this list of ETFs without cringing that I'm underweighting some of my favorites. Some that come to mind immediately are Google, The Trade Desk, and Palantir. We will talk about those in another video. If you've watched my other videos, many of the ETFs in this video will be familiar to you because I've made 5 to 10 minute videos on almost every single one of them. I urge you to check them out if you want deeper insights on what I'm presenting here. First on the list is the Global Carbon ETF from CraneShares. Ticker is KRBN. This ETF moves with the price of carbon allowances from various carbon trading systems around the globe. What does that mean in layman speak? As a strategy to battle climate change, governments are limiting how much CO2 their businesses are allowed to emit. If a business wants to emit more CO2 than the government has allotted them, that business needs to go into the carbon market and buy additional allowances from their peers. But those additional allowances are priced by the open market. Holders of KRBN are part of the open market, and as governments continue to artificially lower the supply of new allowances, year by year, KRBN holders like myself stand to benefit. The bold thesis on this is that between now and 2030, more governments will be creating these carbon allowance systems, which means more profit for KRBN holders. I have 5 or 6 videos on my channel about KRBN. You should start with the overview and work your way into the more advanced videos. The second ETF on my list is Wcld from Wisdomtree. In a world where we are overrun with tech, cloud, and software ETFs, Wcld stands out as one of the best ETFs to capture the growth of this exciting space. It's been said that we're only in the first inning of the cloud computing revolution. I'll go a step further with that baseball analogy. Not only is it the first inning, but I don't recognize half the players on the field. There are so many new publicly traded tech companies, particularly those with cloud-centric businesses, that I can't do my due diligence fast enough. That's where Wcld and the ETF approach come in. It utilizes an equal weighted tactic and rebalances twice a year. This rebalance allows newly public companies to get added to the portfolio, and all this access to growth only comes with a modest 45 basis point expense ratio. I covered this ETF in my best ETFs of 2022 video. Check that one out if you're looking for extra insight on Wcld. The third ETF on my list shares a similar storyline to Wcld. It is newly public companies operating in areas of tech that I haven't kept up with. It's not that I'm lazy, it's that I own businesses outside of YouTube and I'm pressed for time. But I love this sector, and that's where DAT enters the conversation. It's a newer ETF from the folks at ProShares, and it focuses on companies specializing in the data revolution. Data is the new oil. I just had to say it for old time's sake. Old time's sake, as in my last video. The thesis, broadly, is that companies are investing more and more dollars each and every year toward data analytics and processing. DAT capitalizes on that trend. I have a video dedicated exclusively to DAT in my channel. Give that a peek if you want further insight. Fingers crossed that I don't regret this ETF. Get it? That I don't regret this. Okay. I don't think I will. I could see this ETF easily returning 20% every year for the next decade. It is worth checking out. The fourth ETF to my list covers one of the areas I am most confident about. The area is semiconductors. There are 3 ETFs that each offer a compelling case. You have SOXQ from Invesco, SMH from Van Eck, and XSD from State Street. Their differences are subtle, but over the long haul, subtle could grow to be monstrous. XSD is the obvious outlier because it tilts towards smaller companies. The holdings of XSD have an average weighted market cap of $53 billion. SOXQ and SMH more than triple that amount, $184 and $234 billion respectively. So just like Wcld, a tilting towards smaller, less bloated companies has returned better results than letting the bigger companies steer the ship. Will that trend continue? I'm not sure, but I'm splitting my semiconductor allocation in 2, half XSD and half SOXQ. Here's why. SOXQ gives me outsized exposure to Nvidia, Qualcomm, Lam, AMAT. I do want that, but I also want exposure to the smaller semi companies too. I think this is the best way to play it. For a full thesis on semiconductors, you owe it to yourself to check out my SOXQ dedicated video and my semiconductor shortage video. The fifth ETF is more general than the previous ones. We all know that diversity offers protection. So for diversity's sake, I want a general growth ETF, something that gives me exposure outside of just tech. I'm choosing VUG from Vanguard. This behemoth of an ETF has over 180 billion in AUM, a respectable performance history, and exposure to non-tech growth names. That means things like Home Depot, Costco, and Moderna. It also means Google, Facebook, Amazon, and other tech companies that aren't in the tech sector. It's important to not think of Vanguard ETFs as boring. Think of them as efficient. The Vanguard website isn't about flash. They don't have crazy themes and super complicated ETF structures, but they're cheap and they deliver as advertised. VUG should be a staple in any ETF portfolio as far as I'm concerned, because it will continue returning 19% every year going forward. So there we have it, the first 5 ETFs with the potential to deliver early retirement for the aggressive investor. KRBN, the Global Carbon Etf, Wcld, hypergrowth cloud companies, DAT, the Data Refiners ETF, XSD and SOXQ for complete coverage in semiconductors, and VUG for general growthiness. What do you think? Let me know in the comments. Like I said before, this video is only part 1. There's 2 more videos on this theme. The best way to make sure you don't miss these videos is to become a subscriber. Be sure to browse the other videos in my channel, and if this is your kind of content, you'll like what I've got there. Thanks for watching, and I'll see you on the next one.